Yeah, I'm losing my edge.
True diversification in futures. This is something that actually I didn't think about it this way until now, which is funny because I wrote the whole segment yesterday. But diversification in futures might be the easiest product type to get diversification down in, Pete. And I say that just because you don't have thousands of single stocks in the futures industry. And I know that that's a nice thing to have for those stock and options traders. But since you only have a handful of equity products in the futures product type in that futures world, you're actually forced to break into other asset classes. And you're already, by doing that, kind of diversifying from the start here. So easier, I would say, in futures. But I wanted to dig into this diversification.
Right. And Frankie, I'm glad you went through, because, you know, the term diversification within the equities world, you and I have looked at this, and we don't want to say every stock is the same flavor, but they all, you know, they're, whether you're in tech or in basic materials to an extent, is that diversified? Absolutely. Much more so than owning Amazon, Apple, and Google. But the degree of diversification, you could challenge. And it tends to be on when you want that diversification or that independence of occurrence most, that's when a basket of equities don't necessarily give you that. So I like the idea of you talking about the next, and I don't want to say true diversification, the next level of diversification. What, you know, how do we achieve that, and how heavy a lift is it to do it?
And well, it's funny because at the end of the day, this segment is going to be hopefully interesting and helpful for people. But diversification is one of those words that always makes people think like, oh, this is going to suck. Like this is going to be like hours of time. And I have to figure out diversification.
I was told there's no math on this quiz. Yes.
Yeah, exactly. It's like, I'm going to have to pay some jerk over at like Merrill Lynch Wealth Management to diversify for me. Disclaimer, I actually worked at Merrill Lynch Wealth Management.
And you know what? We talk about those top cards and those little video sports moments being worth so much money now. Frank's picture off of his Merrill Lynch employment card. What I would be I don't know what I'd be bidding on that one, but that was a classic.
Oh yeah, I looked so happy in my suit.
You were
and tie.
The definition of miserable in that.
Oh my gosh! But diversification is actually pretty easy to accomplish, and I think that a lot of the work is actually done for you already if you are trading, you know, stocks, rates, metals, FX, and energy. And so Eric emailed us, Pete, and I answered. Pete is he's bad with technology, so it takes him a year to answer tweets and everything else. So I answered Eric, and I was like, you know what? Let's just talk about this on the show. And this is not exactly what he said, but it was similar to this. He was like, you know, I keep my options trading and my futures trading, all of my different trading. I like to keep it into these different asset classes whereby, you know, 50% is in stocks, about 20% in rates and metals, FX, and energy, predominantly in stocks, but he sprinkles it throughout the other asset classes. And his question was more specifically, you know, when I look at beta weighted deltas, should I be worried about the fact that my number is, you know, is X amount? And I simplified the question to the fact that, like, if I have some trades in all these asset classes and the percentage is laid out thusly, but I have like a net position where it's like, oh, I'm actually I'm more short than I am long. Is that something I should be worried about? And what I want to do today is just provide a couple of light numbers to hopefully ease people's minds and help keep them from where a net position that is negative or positive overwhelmingly is actually a problem. Now, before we do that, I want to dig into correlations, which, yes, change. But today, I'm going to give you some numbers that are very robust, as Pete likes to say, that go back multiple years. And so hopefully what you look at today with us can ease your diversification mind for the next several weeks and months here. Because, Pete, you see this movement. This is the correlation between the small stock market and the small interest rate market. And what you see here is, yeah, a lot of back and forth, a lot of going from, close to 1 all the way down to right now, actually below 0. But what you see is an average value that is very high there. And today I just want to look at some long-term averages for people to live by for that foreseeable future, because this, Pete, correlations can change every single day. You can look at the fact that, the correlation is positive between these two markets, but they're moving in opposite directions today, of course. But don't get bogged down in that. Hopefully today, the numbers that I'm about to supply you with is something that you don't need to check for the foreseeable future, right?
Right. And that's honestly, that's why we want to use correlations, because, we look for divergences and then within correlated products. Well, if you get a divergence, the correlation suffers. It's just math. It's really that straightforward. But the ability to have to readjust your correlations, that's one of the reasons we look at rolling correlations or correlations over a period of time, because trying to chase a daily correlation, not only is it not productive, it really is, it so clouds the decision-making process.
Well, going back to this, it's like, okay, well, if I look at the correlation today between stocks and bonds, then I'm diversified trading. I could be short stocks and bonds, or I could be long them, and it doesn't matter. But if you measured it just a couple of weeks ago, you would see that, that green correlation there, that means that I shouldn't be, short both of them or long both of them. But what we're going to do is actually fast forward here to the average correlations to stocks of these other asset classes. And I did the correlation to stocks because I think it is, no matter how, professional you are as a trader, I think it's where everybody starts for the most part. Yeah. And with that being said, you can see here that if you are short stocks and you're short metals and you're short dollars, or you're long all three of them, and you have that net position like Eric was worried about, like, I've got these deltas that I've got, short deltas in stocks, I got short deltas in metals and dollars. That doesn't mean too much to me when it comes to metals, foreign exchange, and stocks. And maybe, Pete, you can speak a little to the fact that those are, time and again, every time Pete and I have been doing shows together for the last almost 5 years, every time we look at stocks, metals, and foreign exchange, those markets are, you see numbers like this. They're so diversified that you can be short all of them. You could be short 2 of them, long the other one. You could be long all of them, and you're not really betting on the same trade there.
No, and I love it, because we've actually tried to. You can look at economic theory, and there's an argument between rates and the dollar, or rates and metals, even in terms of metals being a non-interest bearing asset and the effect of rates on metals prices. We've actually tried hard to test this statistically to say, there is this dependency, there is this, and it's not like what we found is we can't fit that square peg into the round hole, and that's good, because once you realize that, it frees you to understand that you are not, I think the Texas hedge is the wrong word, but you're not overly committed to a directional assumption by seeing a larger than normal amount of either long or short deltas when you've got a range of positions through these products. Now, can you argue a little bit, well, if you had this and that, I think that is not the exercise you want to do. I think you want to know comfortably within different strategies, which we know is important, a diversified set of occurrences. And as long as we have solid mechanics, that number shouldn't be the impediment for you to diversify your strategies.
And I'm glad that you brought up that story of us trying to engineer, because we have, looked at the data with the idea in mind that we were going to create a stock versus metals pairs trade, and we just couldn't do it. The numbers, the data isn't there. And that's the reverse of what we're talking about today, which is pairs trading. And that's when you're looking for high correlations so that you can trade things off of each other. But what Eric is looking for is these correlations so that he feels comfortable being short stocks and metals, or being long stocks and metals, which I would say, given these numbers, you can feel comfortable with. Now, on the flip side, you and I put together pairs trades between stocks and rates and stocks and energies like crude oil all the time. And so you see here with the correlation numbers, that correlation lends to a good pairs trade, does not lend to good diversification. And you and I know this, and I think we gloss over it often, Pete, which
You're
is
absolutely right.
On a day where stocks are higher and rates are higher, or stocks and higher and crude oil is higher, you and I make sure that we aren't selling both or all three of them, because you have the same position on at the end of the day. And this is where Eric's fears or his question kind of comes through very well. When you're trading futures, you do not want to be on the same side of what I'm just deeming here as risk on markets. Metals and foreign exchange, those are their own animals. So you can be long stocks or rates or energies and be trading those from the long side as well. And you don't have to worry so much. But where you get in trouble is a stock market, an interest rate market, and a crude oil market that tend to move higher and lower together. And so when you see outsized days like today in the equity market, big rally, you see a big rally in crude oil, if you sell both of them, you do have pretty much the same position on. And so this is what I would say to Eric, whether you're beta weighting deltas or you're looking at correlations and your net position in futures, I'm short, 5 or 6 contracts net on net, or I'm long 5 or 6 contracts. You only have to really worry when you're looking at your risk on markets. If you're short stocks and rates and energies like crude oil, that's where it's a problem.